Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
John, thanks for coming into the studio.
Thank you, Owen. It's nice to be here.
Yeah, rode in, no less.
Rode in on my bike from Port Melbourne. It was a massive 4 kilometres, I think.
Wow.
In a horrible headwind, though.
You must be buggered. So we've only spoken once before.
Mm-hmm.
So I'm hoping this conversation takes us in all types of unusual places, but really interesting, given your background. And you know, I find the Australian finance circle, someone always knows someone. I don't know if you've found that.
Yeah, it's pretty small.
But a lot of people say really good things about you. And I'm not just saying that because you're sitting right in front of me.
Who are they?
Yeah, they shall not be named. But they say such great things about you.
Mm.
And whether it's on the investing side or more commonly on the writing side.
Okay.
So we're going to spend a lot of time hopefully talking about that and talking about the business that you built, businesses actually. We're going to talk about investing. We're going to talk about our edge as personal investors and what that means, and so much more. So I've been excited to do this for a very, very long time. So thank you for making the time to come in.
Nice.
So last time we spoke, it was on a live show on a Wednesday night. You had a turtleneck on, if I remember correctly.
I did. I was just doing that in honour of Steve Jobs and had a gin and tonic as well, which is kind of disappointing not to have one here right now at 3 o'clock in the afternoon or whatever it is.
Yeah, I mean, it's a gin and tonic time somewhere, right?
It is.
So I was going to ask you, I mean, I'd assume that you don't always have a gin and tonic in your hand when you're talking about investing, but more importantly, is there anything that you practice in your daily ritual? Maybe it's a yearly ritual, maybe it's something that you do over your life or you reflect on regularly, just something that you do maybe that is almost like religion to you. It's almost like something that you do that maybe a few others do, and you think to yourself, this gets me in the rhythm, this keeps me structured, it keeps me grounded, whatever it might be. Is there anything?
Yeah, there's a few things. There's a little bit of hippie in me, Owen, I must admit.
Okay.
I don't really like to admit that, but it's true. I lived in Byron Shire for about 15 years. It's impossible not to have some of it. Most of it I kind of reject, but the idea of being outside, often on my bike, is something that I do 4 or 5 times a week. And I just like the space of it. So I think that, you know, when you have a busy kind of work life, the temptation is just to rush from one thing to another. And the idea of just pondering stuff, letting your subconscious work on stuff while you're doing something else is an idea that's kind of neglected in the modern world. And I try and create a bit of space to do that. Most of my best ideas have not come in an office. Offices are not, for me, good places to have new ideas. I like to be outside. I like to be trying to do something physical. So I do that. I do use a program called Sunsama, which is quite expensive. It's very simple. Just helps you list all your tasks for the day, order them, and then work out how much time you spend on each compared to what you expect to spend on them. So that keeps me organized. I've got a terrible memory. I used to write everything down in this book here in front of me. That didn't kind of work, but it's quite kind of a nice program to use. And at the weekends, I would like to, the ideal weekend is to have a coffee and set the hammock up on the balcony and read a book for 2 hours in the sun. You know, in Melbourne. You can't ask for much, and I'm not asking for much. It doesn't happen very often, you know.
Yeah. What prompted you to move back from Byron to Melbourne?
My son wanted to play football down here.
Okay.
And my former wife and I had houses next door to each other. It was an unconventional living arrangement, kind of Byron Shire-ish. It worked really, really well. We didn't want to be the Brady Bunch. And I thought just a few years away would be probably good for both of us. And You remember there was a song in the 90s called Wear Sunscreen? You might be too young to remember it. It's quite good. The lyrics are kind of amazing. It's like a modern day If, by Rudyard Kipling. And he said, one of the lines was, don't spend too long in New York because it will make you hard. And don't spend too long in California because it will make you soft. And I think the same thing applies to Byron Bay. Too much time there can make you soft. You need a balance.
Yeah. Melbourne makes us hard, maybe.
I don't know. I think Sydney does. Melbourne's very friendly, I find.
I find it's very, very friendly.
It's just a great place. Yeah.
Okay, so let's start with something that I wasn't going to talk to until a bit further on. But so you started Intelligent Investor in 1998?
Yeah.
Top of my head. Okay.
Yeah.
What were you doing before that, which led to the inception of Intelligent Investor?
Well, I tried 2 other businesses before I started Intelligent Investor. Before that, I realized very early on that I was not the kind of person that could work for somebody else. I remember a summer holiday job that I had at uni where me and the MD had a big disagreement, and it ended up in a few punches being thrown. And
oh, wow.
Yeah, it was that kind of disagreement. And that made me wonder whether I was the right kind of person to work for somebody else.
Yeah, fair enough.
So when I came here, I did. I had a job as a marketing manager in KPMG, and they all knew that I wasn't a marketing person because I was wearing a green suit. And that first day, I knew that wasn't going to be the place for me. So I'd always been interested in words. I always read a lot. So I called myself a copywriter and started working for ad agencies, working on print campaigns mainly, not TV, print campaigns. And then after doing that for a few years, I used to run fantasy football competitions for the major papers here. So all the stuff that's done online, we used to run with this friend of mine and business partner. We used to run the Age and the Sydney Morning Herald and the Daily Telegraph NRL and AFL competitions. And we had a help desk, and we got all of these coupons data entered in the Philippines. Did that for a few years. And at that time, the internet was coming along, and I was saying to him, look, we can get this online, man. Let's do it all online. And you can basically outsource the data entry, not to the Philippines, but to people who are doing the competition themselves. It'll be a lot less admin, a lot less fixed costs, variable costs. And he just wasn't into it. He goes, no, the internet's it's too new for me. Don't want to do that stuff. So he didn't want to do that. It's probably the biggest missed opportunity we had, I think, because we could have been the DraftKings of Australia. That would have been a good thing, but that didn't happen. But he did come up with another idea. He had written a piece of software, which was, so this would have been mid-90s. It was full screen video, 16-bit sound, 16-bit video, good sound, interactive, on Hewlett-Packard touchscreen monitors. And we tried to sell that to chemists, car showrooms, mobile phone outlets, places like that. I think we sold about 20 units. We worked on it for a year. It didn't work. It was way ahead of its time and probably not quite right. But it gave me a lot of experience and got me interested in the technology. He used to say that if you can't get an operating system on a floppy disk, you're just a rubbish coder.
Listen to that, Microsoft.
That's right. Yeah. So after that, I tried a publishing business with a friend of mine where we were doing financial case histories. My experience was largely on the editing and the word side of the business, not the finance side of the business. So he took care of that. That might have worked, but we didn't wait long enough to find out. The checks coming back from the corporate finance people in big corporates took 2 or 3 months to come. And by the time they turned up, we decided we didn't want to do it. And then probably a year or two later, a friend of mine who worked at Huntley's Your Money Weekly as an analyst, he would bring home this Your Money Weekly thing, and I'd read it and just go, this just isn't even in English. I don't know how anybody reads this stuff. How are you meant to act on something you can't really understand? So that became the idea, to do something that was like Your Money Weekly, but was written in a way that brought sort of traditional journalistic skills and a narrative-based approach to writing about stocks. So we started that in 1998, me and Robert Carey.
So I'm going to come back to this in a minute. We'll be covering that heaps. But just so we know, The Intelligent Investor, you can check out, there's a link in your podcast player or your YouTube video description below this video. Click the link there, you can get yourself a free trial and you can read John's work and the team's work. But my second question, which I'd sent to you, was something that I usually...
Second of about 450 questions, Owen.
It was, yeah. So we've got a fair bit to get
There's
to.
There's more work actually answering your questionnaire than sitting here talking about it.
But I think this is one of the benefits of sending. For when I know that there's things I want to talk to with someone like yourself, I do send the questions in advance. Because even I don't necessarily want you to have all the notes in front of you, but I just want you to think about them. And I'd say it doesn't work for everyone. So if you do come on the show in the future, it doesn't work for everyone. It's not the golden ticket. But what it does is it actually, I would say, it improves the chances of it being an 8, 9, or 10 out of 10 conversation, at least 100%.
Yeah, I'd agree with that. Just forcing somebody to think about things that they might otherwise not have thought of because you're thinking about them rather than me, that introduces things where you go, oh, that's actually quite interesting. I hadn't thought about that. And that could be an interesting jumping off point for a conversation.
Absolutely. So the second question was, what's something that you believe about investing or business that few people would agree with you on? And I'm really looking forward to this because, and I don't know the answer, but I'm looking forward to this because this is normally something that other people get really stumped by, and you seem to strike me as someone who thinks deeply about these types of things.
So my answer to that, I think the first part was that most people shouldn't be managing their own money, which for somebody who helps people manage their own money might be surprising. But there's a reason why Intelligent Investor has never had more than about 12,000 subscribers.
What's that?
And that is because the people who shouldn't be doing themselves find out they shouldn't be doing themselves by losing money. And we might wear some of the blame for that, and it might be our fault on some cases. But I think that most people are not predisposed to managing their own money. And it can be an expensive business finding that out. So my advice would be, for most people, would be to stop worrying about finding the next Afterpay, stop trying to find the next Apple, and just invest in good stocks, maybe through an ETF at a very low cost, and hang on. The big mistake that people make when they're doing low sort of fee-based investing is to sell when everything's crazy, and that's the worst decision you can do. So my advice would be to focus on the fees, keep those low, start early, and hang on. Don't spend your life managing your own portfolio and all the time and effort and mental anguish that you go through when you do it, unless you really enjoy it. I don't think we get good at stuff that we don't enjoy. So if you don't enjoy investing, you don't like the psychological anguish that we often bear, don't do it.
I think that's it's something really interesting, because a lot of us do things that we don't like, but we feel like we have to do, feel compelled to do it. Investing is one of those things, I suppose, where you can do it in a really low-touch way, where you don't have to do it day to day, so to speak. You can automate a lot, and you can maybe not set and forget, but close to.
Yeah, that's right.
So if someone was a new investor, would you be giving them the same advice? Or what would you say to them? So we got a lot of people. So most of our audience that listen to this show, John, they're in their 40s, 50s, 60s, 70s.
Yeah.
So a lot older than what people might suspect. We do have some, very few, in their 20s. Quite a few in their 30s.
Yeah.
But a lot of investors that aspire to be good investors and or even just manage their own wealth. If they're early in on this journey, early on in it, what would you say to them?
Well, I think the first thing I'd say is be prepared to lose money and be okay with it. The cost of educating yourself is lost money on stocks that you maybe shouldn't have bought, or bought too expensively or sold too cheaply. That will be the first thing. You've got to get over the idea that losing money is a mistake. There are individual mistakes, but you're going to lose money. There are going to be times where you lose money, and it's going to really, really hurt. And if you can survive that pain and you kind of enjoy it, and you look to those periods as opportunities to learn, and you're prepared to put the effort in to read the books and read the research and analyze your decisions and think about how you're going to approach things next time, and you get some satisfaction from that sense of improvement and you enjoy it, then by all means go ahead. But I just don't think most people are like that. They're not prepared to do that. And the pain of losing money, people really, really feel it. And that stops them from making good decisions.
You know, there haven't been many people that have told me or told us, listeners of the show, that it's almost like you've got to enjoy that pain. You've got to, you've got to run towards the flames, right?
Right. If you look at The Big Short, which I think is a great document about the kind of people who do make money at a time when everybody else is scared shitless. These are not normal people. They're weirdos. They're outsiders. They're people who don't give a shit about what other people think about them. They stick out like sore thumbs. They're often sort of unsocial. They're not your average human being, because you can't be an average human being and go against what everybody else is doing. You know, if you're going to go against what the herd is doing, by definition, you are not part of that herd. You're kind of exceptional in some way. So this is where, I know you want to talk about Warren Buffett, and, you know, I'm kind of sick of Warren Buffett, but he's kind of a misrepresentation of what a really good value investor looks like in my book. He's kind of folksy, he's approachable, he seems a very well-balanced and ordinary human being. And most of them aren't. Most of them are not. Even in Intelligent Investor, like, we're a bunch of weirdos, really. We're kind of oddballs. And I do remember saying to somebody once, God, these people I work with are so weird. And she said, well, you know, so I can't understand why I get on so well with them. She said, well, because you're pretty weird too. And that's it. I think that's it. So you do have to be, I'm not saying it's a prerequisite, but there are things that you need to be inquisitive about that most people prefer not to look at.
I would agree with you that most people are weirdos that are good investors.
Would you?
Oh, yeah. Strongly agree with that. In fact, I'd just say, even if they're not good investors, just investors in general, people who maybe think they're better than they are.
Yeah.
But I was going to ask you then, okay, so why is it so hard to go against the grain? Like, why do we find it so difficult if you are quote unquote normal, quote unquote? Why is it so hard in that moment of crisis, take The Big Short as an example, to go against the grain?
Well, because that's not in our evolutionary biology, I think. You know, we're herd animals. I remember being at the MCG with two of my three children for the 2020 World Cup final. And I don't know how we got onto this before the game, but we were talking about this. And we were talking about how you could put a human, a monkey, a lion on an island, and the human is probably not going to win. But if you put 30 humans and 30 monkeys and 30 lions, well, the humans have got more of a chance. And if you look at the MCG, there was 110,000 people in there. We're all sitting there nice and calm, enjoying it. If you put 110,000 monkeys or 110,000 lions in there, it will be absolutely bloody chaos, total chaos. And this is why we're herd species. That's how we've managed to get 7.5 billion people on the planet, through collaboration and feeling a part of a group. And we know that when we're not part of a group, all sorts of psychological things go wrong in us. So I think that's the reason why we find it difficult to go against the predominant narrative, because it just strikes at the very core of who we are as human beings, which is to be a part of something, to be a collective. Have you got a different view on that? You look as though you're not buying it.
No, I do. So I'm thinking another layer down, which is, so a lot of the reason why we do that is because we have like a narrative bias. We believe in the stories. If someone runs, then everyone should run. That's kind of the thinking, is like they've seen something they believe in. We should probably think the same thing. And I was trying to think of the Sapiens concept here around like the evolution of our stories and how that brought tribes together and people survived and in groups and what have you.
Yeah.
And I'm trying to untangle that then for the misfits who don't buy that narrative. So what is it that goes off in their head that then think that they're not part of that, if you understand what I'm thinking? Is so they see those lions on the island and they think, oh, well, the other 29 of us are going that way, I'm going to go this way. Like, what is it that makes the investor go towards the fire? Is it an understanding or a lack of understanding of human nature? Because I think it's almost an elevated understanding of human nature, but a certain distance from it that you don't think you're part of it.
Yeah, well, there is a weird tension in all of us, I think, between want to be part of something and want to be an individual. And I think if you look at the big inventions that have kind of motivated and pushed humanity, often they're outsiders who are making those kind of advances. Oppenheimer is kind of a good example of that.
Yeah.
No, it's not just a Big Short; it's in other areas of life as well. So, what draws those people to think differently, to behave differently? I don't know. Maybe it's genetics. Maybe, as a species, we have this conformity and this desire to be part of a herd, but it's kind of unsafe. You need a certain number of people who are going to do the opposite, just as a risk-taking exercise to see what you can do that the herd wouldn't do. I don't know. I've got no idea. This isn't my area of expertise, Owen, but it's kind of interesting to contemplate.
So yeah, it is. So like, the orangutans and the what's the Graham and Doddsville, the disciples.
Super investors of Graham and Doddsville, yeah.
Where you could flip enough coins and blah, 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 blah.
Right.
Is it random chance? So let's take...
Well, it absolutely could be.
Get enough monkeys on a typewriter.
Yeah, and you get Shakespeare. Yeah. It could be that, and Buffett says that about himself. And we accept that. Like, we've got a reasonably good performance record over 20 years, but we might just be flukes as well. We might be. And most people don't have the humility, I suppose is the word, to accept that, but it's true. It's absolutely true. There's a lot of people out there managing money, just by sheer chance. Some of them are going to do very well over a very long time. Buffett could be one of them.
Do you actively seek out people that
are weirdos? You want the right kind of weirdo, I think. So
crazy and right.
Yeah, crazy and right. So if I think of some of the people that we've had through the business, still work in the business, I won't name any names, but one used to bring all his CDs to work and had his 5 different types of breakfast cereal on his desk and stayed there all day. And another one would eat his sandwiches and the bread would just go everywhere. And at the end of the day, he'd tip his keyboard upside down and tip it. So all the bread fell out. This is kind of what you live with. I remember Gaurav was saying, I was asking him how he met his wife, and he said, we were at a party and we were the only 2 people who wanted to talk about American foreign policy. It's those kind of people, the curious and the slightly odd.
Dates, correct me if I'm wrong here, but you sold Intelligent Investor in 2004.
Yeah.
The question is why, and then what did you do?
I sold it, and this is something you don't know, because for 2 reasons. Like, running a small business is really hard, as you would know. I think if most people knew what it was like, you probably wouldn't go into it if you were sane. I don't regret it in the least. I've had a lot of fun and really enjoyed it. But it was tough. It was really, really tough. And we started in 98, and there was the Asian crisis almost as soon as we opened our doors. And then there was a financial crisis. And I have to say, we made a lot of mistakes during the financial crisis. And we didn't get the bargains we should have done at that time. And And I was diagnosed with leukemia, I think, in 2003. And I had a life expectancy of 8 years. We had 2 kids. The next one came fairly shortly after, like a couple of years after my diagnosis. And I didn't think I was going to live that long. So I wanted to just live quietly and hang out with my kids. And unfortunately, like, I've outlived that expectancy. Now I've gone back to work.
Can I ask you a personal question about this?
Yeah, of course.
When you were, I'm guessing you were sick.
I still got it, by the way.
And you presented to the doctor and you got tests done and whatever, and you got that news. What did that mean for you? What happened in your head?
Oh, it's kind of hard to go back to it, to be honest.
Yeah. And feel free to.
No, it's okay. I don't mind talking about this stuff. A lot of people go through this, like more than you think. Like you realise you're one of millions, and you talk to a nurse, and you go, "I've got leukemia." And they go, "So what? Another one." Well, the first thing is shock, and I think the second thing I did was kind of scramble for some kind of control over the situation when you don't really have any. So that's why I think people run off, like I did, doing weird diets and meditating and doing silent talking, silent retreats and all of that kind of stuff, which I did. It became a vegan for about 4 years. And I don't think any of that stuff really had any impact on the progression of the disease, but it does give you a sense of, I wouldn't call it psychological control, but some kind of influence over your own body, when really you're just handing it over to the medical profession and they just say, well, do this and take this and all the rest of it. So it was difficult. But once I was in once that the shock had sort of passed and we moved up to Byron out of Sydney, it was quite good. It was okay. I think in some ways I've been lucky because drugs have emerged in the past 20 years that have just really helped people with my condition. But I've also been lucky in that it just gave me a different focus, a different outlook on life. So it didn't become about money or ambition. It just became about staying alive for the longest possible time. So I've got a lot of good habits now, I think, that have support that. So whether it's bike riding or yoga or just taking time out, not letting things get on top of you, that's really helped. I think there's a Chinese saying for everything, isn't there? But they have one that says, if you have a serious disease when you're young, that's kind of lucky. You probably live a long life, and I think that if I'm lucky, that might apply to me. I wasn't expected to get to 60, let alone. Yeah, so.
I'd like to double click on that second part, which is, you said you don't let things get to you, and it kind of changed, and you become lucky from going through this. And the reason I did ask that question is so that I could understand, at least in a little bit from the distance, what this might have done to change your trajectory in life. So before this, you may have been ambitious, as in your words before. You may have been ambitious and driven to something, and then snap, something changed your direction, and you've gone over here instead of that way.
Yeah.
What are the lessons we can draw from what, at least in your mind, of what could you have been focusing on beforehand versus now, if that makes sense?
Yeah, no, absolutely, yeah. Well, who was that really brilliant Australian cricket commentator, Kerry Hughes? What's his name? He's extremely funny. I think he retired a few years ago, but he was asked, what? He was asked by another commentator.
Kim Hughes.
That's it. Oh, no, it wasn't Kim. Oh, no, I don't think it's Kim Hughes.
Okay, no.
Kerry something or other. Okay. He was asked, if somebody came to your house and looked around, what do you think they'd say? And Kerry said, I think they'd say, you probably should have done better. And I feel the same way about my life. I probably should have made more money than I did. I probably should have reached a higher height, but I'm absolutely fine. In fact, I'm pleased that I didn't, because having leukemia and having that time out just gave me a different kind of focus about what was important. And I would say I've had an interesting life. I feel as though I've done some interesting things. I've got lots of friends. I've had lots of marriages. and it for me, it feels like a good life. You know, it feels like a good life. And the people that I know who have got lots of money, and they don't seem happier to me. They really don't. So I don't know. We need it. I'm not saying I haven't done badly, because, you know, I've done okay, and I'm probably better off than most people. So I'm not saying that I'm in the dirt, but above a certain level, I think money just brings a lot more problems. And if you can fly business class when you're going internationally and go to a restaurant where you don't mind spending $250 for a nice meal every quarter, I reckon that's a good life. You know, like if you're at that point, you've done really, really well for yourself. And the rest of the money is just going to be a burden to your kids, because they're going to expect it and sit around and fight over it, and, you know, leave them enough to just get a deposit on a house and let them live their own life, rather than be dictated by the pile of cash you drop on them.
So...
Jesus, we're going off course here, mate.
No, that was 2004.
Yeah.
So you briefly mentioned it off air. You were the founding partner, if I'm not mistaken. Is that right?
One of the founding partners.
One of the founding partners of Private Media.
Yeah.
This occurred, as far as I'm aware, at least the business started in around 2004?
Yeah, we bought it a little bit later than that. It was mainly, the major shareholders were Eric Beecher.
That name sounds familiar.
Yeah, he's been in the news a bit lately because of the Murdoch case.
Okay.
Yeah. Di Gribble, who founded Text Media, one of the most brilliant people I've ever met. John Wen Ho, who is an artist. A good friend of mine. I was at his place a couple of weeks ago having dinner. And myself, we bought Stephen Mayne out. So Stephen Mayne started Crikey. I was one of the first 500 subscribers of Crikey. And I used to call him up and say, Stephen, look, you're just not getting the marketing right, mate. You've got to work on the marketing. Like, I've got a renewal notice for this thing. You know, there's money. I'm waiting to pay you some money. You just got to let me know that I need to pay it. It's, I've never been good at that stuff. And anyway, he once told me that he had 120 people at his wedding, and he's only talking to like 10 of them. And luckily one of them was his wife. But it was something like that. And that's exactly the kind of journalist that I would aspire to be, somebody who doesn't mind burning the bridges for a story. And I think Crikey at that time did that. So, we put some money together and bought Crikey, in 2006 or something like that.
And it's still going today?
Still going strong. There's a few other websites attached. We've launched and sold in the past, but it was one of those things that I didn't do that for money, did that for interest, and that was lucky, because it's been really interesting and it hasn't made a lot of money.
So you've moved up to Byron and living, and you're vegan.
A vegan yogi.
Yeah. You're up there in the Byron Shire, enjoying the beaches, enjoying a bit more humidity and rain. So you were dealing with obviously the health issues and everything at the time, but were you still investing at this stage?
No. I came out of, when I sold it, I just didn't want to do anything related to it. I just wanted to have a complete break. Which was, in retrospect, it was not a good decision financially, but it just felt like the right thing to do at the time. You know, I wanted to leave that behind for a while. So, no, I didn't really do much at all.
So we just...
I changed a lot of nappies.
I was going to say, yeah, kids. So if we fast forward a bit then, eventually you come back what prompted you to go back to it then?
I sold the business we sold the business to Greg Hoffman and Steve Johnson, runs Forager.
Yeah.
Greg's a private investor. And we had made a lot of mistakes during the GFC. My first marriage was sort of on the edge. And they said, well, do you want to come back and help us try and right the ship? And that would have been 2009, I think.
Right,
which I did. Of it. Yeah, which I did. And we got it back on track. And I worked in Sydney on and off for 2 years and then went back to Byron Shire. Had the kids sort of 50-50. And then I can't remember when InvestSmart bought it out, but it's probably a while back.
How did it change from the time that you were running the ship, it was yours completely, to then today? Like, obviously it's owned by InvestSmart on the stock exchange. And how has it changed for you?
I don't think what we're doing now to what we were doing back then is that different. I would say that what happened with Greg and Steve was that, and I think they're quite different investors to what they were back then, but one of the traps of value investing, so if you read the original text, Intelligent Investor, Ben Graham, you don't need to read the whole book. It's kind of boring. Chapters 4 and 8 are the ones that everybody says you should read, and probably true, and you get the most value from that. But the original premise of value investing is that, you do a sum of the parts valuation, and you go, well, it's got, $100,000 worth of equipment that you can just sell off, and the market cap's only 80,000, so there's some value there. Let's buy it. There was a tendency to look at more speculative stocks on that basis, and I think that generally that's just a more risky type of investing. If you buy, you might be, in my view, you're better off buying a higher quality growth business at a higher price when things tend to go right in those kind of businesses. And we've seen that with the ResMeds and Cochlears and CSLs of the world. The best things are rarely cheap, but nice things happen to good businesses. When you're doing some of the parts, sort of cigar butt investing, which is the phrase that people use, it's something that is thrown away and you pick it up and there's some value left in it. There's so much scope for things to go wrong. And some investors do it really well, but I don't think we do. So if you look at our best investments over the last 20 years, they've been good value, good quality growth companies that we bought at reasonable prices. So we've got a buy on ResMed at the moment. It's a great company. The price is probably the lowest it's been in 10 years, or the multiple is the lowest it's been in 10 years because of all of this weight loss drug fear around it. That's the kind of business we tend to do well at. The cigar butt stuff that we're doing a lot of in the run up to GFC and post GFC era, a lot of things went wrong there and we lost members a lot of money. So that's one of the areas where we tighten things up, and now we're very careful. But if you look at our speculative buy recommendations, our record isn't that great. We had some big winners, but we lost a lot as well. But our record on the kind of high quality buys is much, much better. We'd have a really good performance record if we didn't make any speculative buy recommendations.
I've once heard it put to me that that type of deeper, let's call it deeper value investing, is kind of like you're trying to buy a dollar today that might be worth 90 cents in a year, but you try and buy it for 80 cents,
right,
so to speak. It's like you're catching a falling valuation.
Yeah.
And as you said, would you say it's time is kind to good businesses?
Yeah, that's right.
Yeah.
That's right.
So that would be the opposite of that. Okay, so just one thing to double click on there is, what have you changed from the GFC then? You said a lot of people lost money during that period and you've kind of righted the ship a bit. What would you have done differently other than just making more of these speculative buys?
We've been on the same journey that our members have. Like, many of our members have been with us through that period. And we lost the same kind of money that they did because we always put our money where our mouth is. We invest in the stocks that we recommend. They're in the funds. And we all learn, I think. Like let's say that's a one-in-century event. I mean, there's a lot of one-in-century events that are happening right now. Probably going to happen a lot more regularly. So I don't want to say it's not going to happen again, but it was a very, very rare event.
Biggest drawdown in history.
Biggest drawdown in history. The opportunity to lose money during that period was kind of endless. We did a good job of staying away from the dot-com boom. We did a good job of staying away from the banking sector, but we bought a lot of rubbish, I think, during that period. And we lost a lot of money personally. The team lost a lot of money during that period. So we learned. And that's why we just moved our focus away from those kind of stocks because we realized we weren't that good at it.
Mm. So I wanted to talk to you about this idea of AI replacing stock pickers. And I feel like this is as good a segue as any because you mentioned before that the band of weirdos or whatever, like it's a kind of like
Can I just apologise to my work colleagues? Like you're not weird, you're great people.
Yeah.
Lovely people. But we are a bit weird.
Not just specific to the intelligent investor team, but just generally speaking, people that are contrarian type people, right? I think that's a really interesting framing for the conversation about AI replacing investors. In particular, I mean stock pickers, right? How do you think about that?
I mean, I did do a couple of stories on AI a few months back. I do think it's a bubble. I probably think it's going to be more important than the internet. There's some stuff that we kind of do as investors that AI could codify. So we would often go to an AGM and count the number of times that the CEO would use I or talk in the first person. We might count the number of times that the CEO would interrupt the CFO or other people at the table. And you can say, well, that's a kind of weird thing to do, but these are kind of cultural factors that can be quite important. I think if you go back to the Qantas AGMs, you would have seen Alan Joyce be quite dominant in those meetings and the board almost subservient to him. It might have given you an indication as to where things were going. It's not unusual in some companies where you've got founder-led companies, but often, the charismatic CEO can often end in disaster, and doing that kind of stuff can be useful. A lot of those cultural factors can be assessed with AI. You might go on to Glassdoor and look at what the ex-employees are saying about the company. AI can do that. It's a painstaking job, but AI could do that. So there's a lot of scope there for artificial intelligence to do what we're doing. Whether it replaces, I think it should replace those investors that aren't doing a very good job. And there's plenty of them. The funds management business is way too large in my view. The failure rate after 10 years is something like 75 or 80%. Well, if AI takes all of those jobs, well, that's great, I think, because it means less people are going to get ripped off.
And those other people can go and do something more
productive. And they can go and do something, they can go and invent a drug or something, or build a road or...
do something else. Yeah.
Become a dog walker.
Okay, so this is really interesting. So then, do you think, though, that those idiosyncratic, those quirky habits of successful investors will be automated out, basically will be replicated out by these contextually aware, generative AI type things? We're not going to drive straight down into the engineering of it, but is that if you could just have a finger to the thumb suck, finger to the wind, whatever you want to call it, do you think that that's possible?
It's possible. It's certainly possible. But if somebody develops an AI data set that allows you to do that, then I'm sure another one can do it. And so I don't know. I don't know. It's quite possible that this will drive the movement from active to passive funds. I think that might be quite a good thing for most people. But somebody needs to set the price. And if it's AI or if it's a human being, does it matter? I think so, because the human brain is a very complex thing, and the idiosyncrasies that we bring to assessing a stock, I don't know whether it's going to take a long time for AI to replicate that, I think. I'll give you an example. One of your former employees is now with us. We were looking at Supply Network. I just couldn't understand how that business was making really good margins. And we ended up sending him down to the local warehouse in Western Sydney, and he went and had a look, got in touch with the CEO, and the CEO emailed him back the next day and then called him and said, yeah, come down. And he said, I'm sorry, it's taken 24 hours to get back to you. If you were after a part, I probably would have got back to you in 90 minutes. Now, that tells you something about that business. Whether AI can pick that stuff up, I don't know. Maybe it can't pick that up, but it picks up that kind of attitude in different kinds of areas. But I think those, just going out there and seeing those things and those cultural factors, they're becoming more and more important. So I think we're going to be all right for the next 10 years. We hope. We'll see how we go after that.
Yeah, I don't know. I have this view, which is that I don't know if it's founded or not, but I have this kind of view that as long as humans make the decisions, because we're not rational beings, as long as we are the drivers of not just capital, which is the thing that we're talking about now, but the drivers of purchasing decisions, I feel like we have a fighting chance as individual investors. That said, if you just look at the share prices of big tech over the last few years, and they've adopted these language models and seen how you can keep people watching for longer, serve them better ads, serve them more addictive content.
Right.
Maybe they can replicate that human experience a lot quicker than we appreciate.
Maybe.
Anyway, it's going to be quite interesting to
Sure
figure
is.
out. And for young people that are considering moving into this field, I think it might become more competitive if we see more active managers squeezed and more people using tools like this.
For a market to function, you need a range of opinions though, right? So if you don't have a range of opinions, you don't really have a market. The buying and selling price is always the same. So the market ceases to function. Somehow we've got to find a way of keeping that diversity of opinion in the market. And whether it's AI or individual investors, I don't know. But it's a problem if everybody's thinking the same way, because nobody is really setting the price. Then you don't have an effective market.
So one of the questions I wanted to ask you is why is the learning curve on investing so steep? And the reason is, I've spoken to you previously about your founding of Intelligent Investor and you trying to interpret those Huntley's reports thinking, what is this gibberish?
Sorry, Ian.
Yeah, no offense. But like what... It's not just them, but it's specific.
It's everybody.
It's everyone.
It's everybody. Yeah.
Everyone who's presented with the financial markets just thinks, this is so far over my head, I don't get it. Why?
Well, that is a very interesting question. I have a friend I was out on a ride with a couple of years ago now, and we were having coffee, and he's done some very interesting things. He built his own plane and flew around South America for a few years. Not a stupid bloke by any means, very smart. And he said, I've been reading UBS research for 5 years now, and I still can't work out whether I'm stupid or they're stupid. I don't know who is the idiot in this relationship.
Sorry, UBS.
Sorry, UBS. Yeah, that's right. I said, no, it's you, mate. And I think that kind of sums it up. So I've got a rant about this, and I'll try and not rant too long.
Rant away.
But there's a phrase it was used in a play called The Doctor's Dilemma, George Bernard Shaw, where he says, one of the characters says, every profession is a conspiracy against the laity being ordinary people. And there's kind of a reason for it. You know, doctors and lawyers and accountants, they need a language to communicate with each other that ordinary people don't understand. So there's a separation going on there, but it's a necessary separation. You see a lot in medicine. I think it's less necessary in finance. Finance doesn't need to be as complicated as it is. And here you are, you've got a whole load of people. I think the nature of the industry is essentially parasitic. So how do you continue to extract fees from people? Well, it's really by making them feel stupid, I think. It's one of the ways that you can do it. And so you develop this language. None of this is explicit. This is happens subconsciously. And you develop this language, and you end up speaking that language to each other. We do that. We do that as well. It's unavoidable. And one of my jobs is like a guardian of eliminating the jargon and the acronyms and the boring phrases that brokers and other people in the industry tend to use. But it's kind of exclusive. And it makes people feel stupid. And when you do that, when you make people feel stupid, then you can charge them more. So I think that's it. It sounds a bit cynical, but I am quite cynical. I think people are right to be cynical about the industry, the finance industry. And that separation between the language that people would use in their everyday lives and the language that the industry uses is a way of extracting more fees and making people feel smarter than they really are. But there are a lot of different aspects to it. It's not just that, but I think that's a major part of it.
Okay. So...
Well, what do you think the reason is?
I think that's the motive, yeah. I think the motive is fees.
Yeah.
It's like a lot of agency. You said parasitic, it's probably fair. I'm surprised working in finance how few people in the finance industry understand finance. Does that make sense? Like, what I mean is, like, so many people who work in the investments industry don't understand investing. Like, just even like the broad concepts of like, how do I open a brokerage account and actually invest? A lot of them don't understand that, and yet they work in the industry. Or the fund manager who has no understanding whatsoever of superannuation.
Yeah.
And you would think that they would understand how those levers are interconnected and it impacts the world. But it almost seems siloed, like a Henry Ford industrial line as an industry where this person does this thing and then it just kind of goes further and further down the corridor.
Yeah.
Until you get to an outcome. And that's where you end up with the layer of fees for every door you pass.
Right. I find it's an industry that is kind of very white, very typical kind of backgrounds that people have, often have been to private schools. It's kind of an enclave that is unhealthy. There's not much diversity in it. And it's easier for a kind of language and a way of thinking and a kind of ignorance to exist in one of these sort of hermetically sealed kind of environment. It's not hermetically sealed, but it's kind of closed off, I think.
I can't... someone said to me the other day, it's almost... I can't remember the phrase, but maybe it's something like you don't know what you can't see. And what I mean, and what she meant by that was that unless you see, in this case, diversity, female investors doing investing, you feel like you don't know enough to do it, or you feel like you don't know that it's an option for you.
Yeah.
So what we're trying to force, in some way, shape or form, is more women in investing roles. This is just an example of what we're trying to do. Because unless other younger women see it, They don't know that they can do that.
That's right. And I was talking to Kate, one of your staff members, before this, and how a female fund manager was telling me she went to her kid's school to do a talk about a career in funds management, and 3 girls turned up. And then 6 weeks later, another parent from the school who was a fund manager went to do a similar talk, and a couple of 100 boys turned up. And personally, I feel as though women are probably psychologically predisposed to be better investors because...
I think so.
Yeah, I think so. Males just to embrace risk, think they're smarter than they are, and women seem to me to be the opposite. I don't know whether this is grounded in fact, but it's just my experience that they're more cautious. They're better at assessing risk and reward, and that should make them better investors. But it's such a male-dominated field, and it seems much more risky than I think it needs to be, that their preference is to invest in property rather than shares, which I think is a loss. And it would be good to change that. But once you get to the kind of place we're at, where it's largely a male-dominated workforce, any woman coming into it, if you're lucky enough to get some CVs from women, looks around and just goes, it's all blokes, and we're not kind of blokey blokes talking about sport all the time, but it's not a natural environment. We got some diversity in terms of ethnic and class diversities, but we don't have a lot of females.
It's so hard. I found it such a hard thing to crack.
Yeah.
Like trying to get females into analyst roles is so very difficult.
What do you reckon it is?
I just think it's that they don't see enough role models. And the role models don't come forward because a lot of the times those role models are brought forward as if it's an example of, here you go, come and speak and talk about this thing. And these women are brilliant on their own. They don't need to come and talk about women in finance.
No.
They just need to be presented as brilliant in their own right.
Yeah.
And I think because there are so few of them, that's kind of where we're at as an industry, is put it on a pedestal, here you go. And I think that also sends the wrong message. So it's a delicate balance. And I just think the more people that come to investing will slowly realize that it's open to everyone. And I think we're seeing that as a generational shift. In our community, we're seeing a proliferation of people talking about money, talking about investing. And I think that this generation is more informed, more engaged, and that will lead to more opportunities for diversity in time. That's my belief. It's my hope. Whether it's a reality, who knows? Yeah.
Well, I hope so too. But I was at Macquarie Bank in the lobby there in Martin Place a few months ago, and they had some new graduates, and I don't know, 60 or 70% of them were women. Macquarie has managed to do this in a way that the rest of the industry haven't. So I do wonder whether it's us, to be honest. I do, because they do seem to have cracked it, but we haven't. And it's just a very tough thing to get right. I think this is almost a decades-long project.
How do you think about educating young people about investing? Like, if you're
better off asking my kids there.
Yeah, if what would you have you broached the subject? Have you thought about it?
Yeah. I mean, a few Christmases back, I said to my kids, I'll give you $1,000 each, but you have to choose from these 3 stocks in which to invest it. And I gave them the research and let them read it, and that's how. One of them took up the offer. So there's money there on the table, and only one, the youngest, took that up. The other 2 were, so you can have $1,000 in stock here, but they just weren't into it. So I'm not an expert on this. I've probably failed my children in this regard, as well as many others. But I don't know what the answer is. If you can get people saving early, I think your life can look very, very different in 30 or 40 years' time. But the time frames are things that they just don't latch onto. They're very much living day to day. And getting them to act is just very difficult. So Scott Pape is probably better off, talking to him like he's done a Barefoot Investor for Kids. Something like that, I think I'm not your person for that.
Yeah, fair enough. It's just interesting the way we pass that baton on to people and the wisdom we try to pass on. And some things are just at different times in people's lives, right?
Right.
Like teaching value investing to a 13-year-old is probably not where it's at. It's probably a later in life type of thing, unless they're Warren Buffett and they want to buy shares at 11 or whatever it is.
I was at a friend's house a couple of weeks back, and they've got an 8-year-old boy, and he was saying, "Oh, JV Hi-Fi result comes out this morning. Don't forget the paper." Okay, Dad. So I think he's done a pretty good job of it. It can sound like child abuse, but it seems to be working for them.
That's probably a relevant way, is like to bring in the brands that they know. I did the same thing that you're doing with. You tried with your youngest. I've done the same thing with my sister, actually. And, she was the one that came to me. I think that was the interesting thing.
Ah, right.
Yeah.
That's good.
Yeah.
That's good then.
And she did read that Barefoot book, actually, the most recent one. And that's why she came to me.
Great.
So that was great. That said, she came to the event that we had in Melbourne last year, and she was more interested in the magician.
Who doesn't love a good magician, though?
It was one for the kids, maybe, but it was actually Kate's idea to bring magicians into it, and it seems to have worked well for at least one in the audience.
That's good.
So people who know you, as I said at the top of the show, John, they know that, I'll say it, you're a fantastic writer. Okay.
Thank you. I don't see myself that way, but I think the bar is very low in finance. It's on the floor. So it's easy to stand out if you can string a few words together without using a cliche or a bit of jargon. So,
well, even if it is a low, even if the bar is very low, why is it important to think about, well, why do you think it's important to have the skill of writing as an investor? And I say that because everyone listening to this will know about investing books. They will know about people that write letters and fund managers and Warren Buffett and Peter Lynch and you name it, right? Even some fantastic Australian fund managers who write exceptionally well. So what is it and why is it important?
Well, firstly, I'd say that we're narrative beings, and you can tell a narrative with numbers, but it doesn't resonate with us in the same way that words do. So I think that the way we've communicated throughout our history is largely through story and paintings and stuff, but largely through story. And words allow us to tell stories, and that resonates with people. So if you can tell a story about a stock or a business through words that create pictures in people's heads about how that business functions, and you embellish it with the facts and the numbers behind that, I think that's going to resonate more. People are going to get that story more than they will if that story is just told with words. That's the first thing. So we have this narrative bias, and when you can tell a story that plays into that narrative bias, and some people can manipulate you in that way. We don't think we do that. We're just keying into that bias towards story and narrative. So that would be the first thing. The second thing I think is that I can't remember who it was, but she said, "I write to find out what I think."
You said it last time, Joan.
I did.
Didion.
Yeah, that's it. Joan Didion. That's it.
Yeah.
There's just a clarifying. So when you look at a business, there are hundreds of points, and you can get lost in that analysis. The act of writing forces you to decide what's important, because you can't communicate everything that you've learned, and you shouldn't, because most of what you've learned is not important. And the act of writing forces you to concentrate on the important things. And say, for example, when we wrote up Premier Investments a couple of weeks back, well, we're not really interested in those low growth chains that Premier owns, but we are interested in Peter Alexander and Smiggle. So when you write about this story, you could write 1,000 words and split it up between the brands. But the Smiggle and Peter Alexander are the only two that you really need to know about. The act of writing helps you realise that. Writing 1,000 words on some of these chains that they own that everybody knows and are only going to grow at 3% a year, who cares? Who cares? So there's a clarifying aspect to writing. And if people can't communicate the story about a stock on a page that you can read that makes sense, well, I'm not going to trust them with my money. I don't think anybody else should either. You know, you need to know why a business functions the way it does, and you should be able to tell it in a story. And if you can't, then I think there's something wrong with the analyst. So being forced to tell a story helps you really understand the business in a better kind of way. So they're two reasons why I think it's important. Maybe the third thing is that in a good story about a stock, you reveal a little bit of yourself and the way that you think. And I know that brokers and fund managers stay away from this because they've got this reverence for the process and it's not about the individuals, but I kind of think it is. Yeah. The process is something you have to talk about just to get rated by the agencies. So there is a little bit of magic that the individual brings to it. And if you're just going to tell that story through numbers, you never see that side of it. You never see the magic that the individual brings, the flair, the insight, that capacity to see things a little bit differently. So when you read a bit of intelligent investor research, I hope, and we're not always successful at that, but I hope that the reader kind of connects with the writer in a way that you might find it's a bit pretentious, but in a novel or a story, you know, like a long form piece of journalism. And you'll be able to tell whether I've written a story or Gaurav or Graham or Nathan. There's a tone to the way that we all write, which is different to each other, and it reveals something about ourselves. So there's a kind of personal connection in a writing like that I think it's valuable, and it delivers a sense of belonging.
Who's the best writer that you've come across? And I might ask if you do have an answer to this. Maybe if you give someone that's not Australian, give one that is Australian as well for context. So people might be familiar with that. When I say best is such a cliche term. Maybe say people who write well. Yeah,
okay. Well, Joe Aston gets a lot of stick because he goes after people. I like him for that. But his writing's exceptional, I think. Like it's really spirited. It's kind of funny. He uses language in a really colourful way. There's very, very few people who can carry that off without sounding ridiculous. But he makes all of his points really barely laid out with a lot of fire and a lot of enthusiasm, and generally does a really exceptional job. I think he's one of the few people worth reading in the Financial Review. He's really, really good. Somebody completely different might be John Cassidy at The New Yorker, who'll write on finance stuff. There's a kind of, what would I call it? He's originally from Leeds, I think, in Northern England. Mm-hmm. You can almost hear that in his tone. Like there's a kind of I've seen it all quality to him, which makes you feel as though you're in good hands when you're reading him. There's no embellishment. It's a complete opposite of Joe Aston. It's just telling a story with the bare minimum of words, but in the most interesting kind of way. And of course, in terms of narrative, I don't think you can go past Michael Lewis. That guy's just got an uncanny ability, not just to tell a story, but to be there at the right time. He's doing the FTX stuff now, isn't he? He was following him around for 6 months before the whole thing imploded. It's unbelievable how he's there on the spot. Yeah. He's just got this uncanny ability right from the beginning of Liar's Poker, which is that's what got me into finance, actually, Liar's Poker. Right. Just found it fascinating. Yeah. Have you read that?
No, I have not.
Haven't you? Oh, it's one of the best books on finance. It's fantastic. Okay. He tells a story of how he got started, and and I think his boss was John Gutfreund, I can't remember how you pronounce it. But he sort of left when he said his bonus was $3 million because he just thought, this is just ridiculous. Like, this bloke's earned $3 million. This whole thing's going to blow up.
So here you go then. Here's a question for you. Talking about you are what you eat, in order to be a good writer, should someone be reading these types of writers?
Yeah, absolutely.
Methodically.
Absolutely. Yeah, absolutely. And not just, I remember when Greg Hoffman, we used to have a tussle because he would say, you've got to read this investing book and you've got to read that investing book. And we had 3 different reading lists with 10 books on them. So there's 30 investing books. And I said, I'll do all of that if you read some literature. And he never kept to his side of the bargain. Now, I read all of his investing
Greg,
books.
if you're listening.
Yes. Get the Emile Zola out, mate. It's been 30 years. And I mean, he does. I don't know if he's reading novels now. I doubt it, to be honest. But that helps. Like, you learn what good writing is by reading it.
Mm.
So I'm a big fan of doing that. If you want to be a good investor, you've kind of got to do the investing classics. But if you want to communicate, read some good books.
Have you ever made that list public?
My reading list?
Yeah, your reading list?
Oh, I could do. Could find it. I mean, it's quite... I mean, read George Orwell, Politics in the English Language, great essay on communication and how language can be used to obfuscate rather than inform. And I think that's a big thing in finance. The language is used to obfuscate and hide rather than inform. There's 6 simple rules in there. In terms of, if you want to read good writing and it's in finance, The Economist is really good. They don't assume anything. They'll say Ford, comma, the motor company, comma. You know, like they spell everything out. And you don't look at The Economist and just see these, you know, a series of acronyms jumping out at you. So The Economist is pretty good. Financial Times is pretty good. The Australian is less good. Financial Review is less good. I wouldn't bother with those 2. Who else would I read? And John le Carré, probably the most economical writer that I've come across.
When you say economical, you mean use of the words?
Yeah, I mean, economical, it's got a horrible connotation, but there's a brevity like there is nothing extraneous in his sentences. Every word serves a purpose. Nothing could be cut. And the thing just breathes so clearly because of how he puts the words together and the words that he uses. There's nothing especially flowery or florid about it, but it's just beautifully simplistic. It's the hardest skill.
Mm.
It's absolutely a harder skill than writing. This is why, you know, journalists at tabloid newspapers are paid a shit ton of money compared to the broadsheets. Because writing, you know, for an age of 11 is a lot harder than writing for a reading age of 18. It's difficult.
Mm.
You know, so using short words is difficult, especially when you've got intelligent people with good vocabularies. We want to use long words.
So other than reading the right people or mastheads, what else do you try to get people to do? Because you
I use a lot of red pen.
Well, yeah. So what is that feedback? Is that people getting feedback, honest feedback on the way that they write?
Mm. Yeah, so if we have a new employee, they go through a kind of retraining camp, deprogramming camp.
You're sent away to a mystery place.
That's right. Yeah. We're going to send you to a casino in northern New South Wales, you know, hang out with the cows. And
see you in 6 months.
That's it. That's right. And here's some mung beans that you can grow for your food. Now, we have a program where I work with them on the structure of a story. So we talk about it, talk about various points and elements to a stock. We develop a structure. They will then go away and develop a first draft. And then I sit there with them and we edit it. Well, I edit it and they watch. We share the document and they can see what I'm doing. At the end of it, it looks normally nothing like it. I would normally do, say, the first half, and then they can try it with the second. And then we'll go back and do it again, and then we'll do it again. So it's normally 3 cuts initially. And we do that for probably 6 months. And there's normally a moment when the penny drops. You know, you'll get a story back and go, okay, they've got it. It's that clear. And they will often realise that themselves. So with Nick, who's our international analyst, that happened after about 3 months. And when I edit his stuff now, it used to take 3 hours and now it takes 20 minutes.
Mm.
So this is a skill that can be learnt by almost everyone. And the industry doesn't need to be the way it is, but they're not prepared to put that kind of effort into communication because there's not that much in it for them. The fees come in regardless.
So if something is produced at Intelligent Investor, I'd imagine there's some sort of principles or rules that you use to communicate ideas with. So in terms of the structure and live editing that you might do. For example, if I was to write an article and it had EBITDA and I didn't explain what that meant, or even what should that even be in there to begin with, the bullshit, whatever Charlie Munger calls it.
Yeah.
I'd imagine there'd be a big fat red texter that goes through that bit.
Well, this is where I have a confession to make, Owen. No. Because for the same reasons I was talking about earlier, if we were to explain that term every time, it would all be there. It would just take up too much space in a way. So we assume a level of knowledge amongst our subscriber base that allows us to use terms like that and not explain them. So we might write it out and then we, put the initials in after it. But we wouldn't ordinarily explain PER, free cash flow, EBITDA, EBIT, that sort of stuff. We don't. We assume it. We used to have a glossary, but we assume it now.
How do you know that you're writing at the right level? And what I mean is, if I was to go into, say I got an author profile on Intelligent Investor, I jump in there and I start writing about modified duration of bond funds.
Yeah.
And where, how to interpret convexity, and everyone would just be, I'd imagine most people would just, they would feel like the website's been hijacked.
Mm-hmm.
So how do you know, other than that super obvious example, how do you know that you are writing, whatever the genre, that you are writing on the level for that audience?
We have a very engaged membership. They really keep us on our toes. Whether they would complain about the use of acronyms, I don't know, because they are often at the level that we're at. So we assume that they know, which is a dangerous thing to assume. It could be possible that we could rewrite the whole thing and explain every term and explain every business with just a clause in a sentence somewhere, and it would appeal to a completely different audience. That's possible. If you're 30 or 40, that might be more to your liking. I'd rather link the phrase to a glossary and let people explain it. Maybe our standards have slipped over the years and, we've been pulled back towards what the industry does because we've all been doing it for so long. I do writing sessions every now and again where I try and compensate for that. But that's possible. That's possible that we are talking too much in the language that we have adopted over the years, and we're assuming things we shouldn't. That's maybe why we only have got more than 12,000 subscribers. Shit, Owen, you've hit on something here, mate.
No, but what I think happens in our industry is a lot of finance people write for finance people.
Yeah, they write for each other. Yeah.
And it just,
for their peers.
It shits me because I'm like, that you are not the audience.
No, that's right.
And so why do we do that? I always look at that and I think, I think part of the hesitation comes from a sense of whether it's, call it ego, call it pride, call it whatever you want, where people sit and they think, I'm not going to write that because I am smarter than that.
Mm-hmm. Yeah, so I've been in businesses where they've asked me to come in and help them write. And often you will hear the phrase, so you want us to dumb it down?
Yeah.
I said, no. You're the ones who are dumbing it down. Like, you're the ones who are being dumb and communicating like this. What I'm asking you to do is harder than what you're doing now. Yeah, but you're not using that language that, we would ordinarily use, so you want us to dumb it down, right? And I go, well, I'm asking you to do what's hard. If you want to talk to your mates because you want the next job up the next ladder at another fund manager, then, yeah, keep talking like this. But if you want to talk to advisors even, because I know that advisors respond to humanist language in the way that all the rest of us do, then you're going to have to change. They really don't see it. It's really difficult to communicate, and they do see it as dumbing down. Yeah.
It's
kind of mad, isn't it?
It is mad because
it is. What other industry do you think could carry on talking in a way that is exclusive to its audience? If Coke started talking like, we're a fizzy drink and we've got this chemical, we've got that chemical, and and we pressurize it under this. It's mad to think that another industry would talk like this, but it happens in finance. Like to sound as though you can communicate with your consumer, with your customer in a way that they understand is dumbing down. It's mad. It shows how arrogant it is, really.
Yeah, imagine if you walked into the doctor and you've got a rash and you come out and they've like something hemoglobin dermatology,
That's
and
right.
you walk out with a prescription. You're like, and someone asks, "So what's the matter?"
I don't know. They just gave me this, and they charge me 2% for it.
That's what we have.
That's what we've got.
That's
a good analogy. Like, if we're doing this worse than doctors. And doctors are terrible at this stuff.
Yeah.
Some of them are, but they've got better over the years. But yeah, and their handwriting, like, what does that say about finance? Yeah. Unbelievable. Well, you mean they've got to dumb down the diagnosis to the customer, to the patient?
You mean they've got to understand that they've got a hernia? I thought they were just going to come back.
What do they need to know for? They just pay me the money.
Okay, so maybe some easier quick-fire questions for you to see how we go. You've been doing this for a while.
Yeah.
My question is, which Australian company brings you the most frustration?
Well, right now it's Qantas. Because I've got 1,200 words to write for tomorrow morning, and I know what I want to say, but I haven't said it yet. What brings me the most frustration?
A lot of people think this might be like a missed opportunity. Might be something that...
Oh, okay. Yeah, I mean, every time Cochlear comes out with a result, you go, wow, why did I sell that at $80? That really hurts. That the frustration that I feel from the businesses that I've sold too cheaply, not waiting for those good things to happen, that inability to sit still on a stock, they're my biggest mistakes, I feel. They're the things where I feel the most frustration. It's not with the shitty businesses that communicate poorly, or you think everything's going well and they come out with a terrible result. It's not. That just happens. But personal frustration at having missed these great businesses by selling them way too early, yeah, they're the frustrating ones. So for me, that's Apple, Cochlear, ARB, ResMed.
Never too late.
Never too late. ResMed is looking interesting at the moment. That's true.
Well, it's an interesting one because so many people have told me that have gone the distance. The marathon investors, we'll call them, that have come on the show. They've said it's the same thing. It's not those companies that I lost money on. It's the ones that I let get away.
Yeah. And
I think there's something to be said. And I think this comes back, it loops through to our point about being contrarian in human nature, in that a lot of the time you have to take it on faith, not science. You almost have to sit there and say, yeah, well, I know ARB's been a 20 bagger. And yeah, it's got this, manufacturing plant in Thailand, and some people seem to be complaining about that one versus the one in Victoria. And, it seems to make sense that it's probably overvalued.
Yeah.
But I'm going to stick with it.
Yeah. That's right.
And how do you sit there when every other people around the table are saying, based on my discounted cash flow analysis, this. And then there's a negative result that comes out 3 months later and you think, shit, well, I probably should have sold.
Yep.
And how do you, how does the brain process that and rationalize that?
Really badly, I think. And in some ways, you often hear from new investors, they say, I bought this at $3, it's now at $2. When it gets back to 3, I'll sell it. And it's kind of like the opposite of that, where you go, I was really smart buying ARB at $2.50. You know, it's $20 now. That's like a good return. That's a really, really good return. I'm going to be smart again and sell it. We just got a bias towards activity. You know, that inability to sit still on a good business. It's really hard. So I get that. And yeah, they've been my biggest mistakes, I think.
I mean, you and I could talk for days about human behavior. And I know it's one of the things that you do write about a lot. So people can dial in by getting a membership, maintaining a membership to Intelligent Investor. But I'm curious, are there any things that maybe anything in particular, any biases in particular, maybe you've read books on this subject, if you defer people to that, where you would say that that's a really good starting point for people to stop and think about how their behavior may be impacting their ability to generate results?
Well, we could reel off the books. Evan, my colleague, Evan Lucas, has written on this stuff. It's worth reading his book. I think the problem with this social science research, there's a lot of problems with it. There's a replication crisis in this kind of research, in what the psychologists call heuristics. So these behavioral biases that we have. And often the subjects that they're using are what they call weirds, you know, like Western educated, intelligent, blah, blah people. So they tend to look the same. And when you try and do it in another culture, they don't replicate in the same way. Sometimes the experiments themselves can't replicate. But the big ones I think are true, like narrative bias, confirmation bias. Those two are pretty strong, pretty kind of obvious, I think, when you think about it. Thinking Fast and Slow was the book that really turned me onto this, Daniel Kahneman. But there's been also, it's a marketing book. I'll think of his name in a minute.
Robert Cialdini?
Yeah, Cialdini. Which was meant to be, you know, a description of how we as consumers can defend ourselves against these wicked manipulative marketers. And of course, it was read by wicked manipulative marketers. Getting the Bible for them.
I love that.
Yeah, that's how it works. The whole Silicon Valley is all based on that principle, really.
Yeah.
That's pretty good. It's quite easy to read. There's some nice examples in it. But I would say that there's not much evidence that you can know about this stuff, but does it change your behavior? Not much. Not much. I think the best way of learning is to do it and lose money as a result of it and then see it. There's not much you can do. You can't have a book replace that kind of painful experience. It's not the same thing.
But the behavior gap is so real for a lot of folks, for everyone.
Yeah. Yeah.
And all the studies that base on this, that try to, like you said, replicate this maybe in the Western context, but seem to justify a lot of these things, like the results from people invest in managed funds and people invest in super and doing more poorly than the funds themselves, and so many different things. And I'm sure all of us listening to this can relate to it. I certainly can.
I'm quite pleased in a way, you know, because if everybody overcame their biases, value investing wouldn't work.
No, yeah.
So it helps if you can be a little bit contrarian and understand the philosophy and the psychological biases. You can see when that's happening. Facebook at 9 times earnings and everything was like, oh God, Facebook's falling apart, and
no one uses Facebook anymore.
Nobody uses Facebook anymore. That kind of stuff.
Yeah.
That narrative takeover.
So there's generally accepted a few different edges in investing. Some of them might be analytical, so that's probably gone.
Yeah, let's assume that that's gone.
Yeah. Informational, that used to be, I think, Charlie Aitken, who came on the show many moons ago, said there used to be something called the Herald effect. By the time it enters the Herald,
Too late.
So maybe that one's gone.
Definitely gone.
Then that probably leaves us with 2, which is the behavioral element, which we've just spoken about.
Yeah.
And maybe the final one might be time horizon.
Yes.
How do you think about that?
Well, I don't think there is any greater advantage that the retail investor has over the professional advantage than over the professional investor than time.
Yep.
Like if you can really think in decades rather than months or years, like we say 5 to 7 years is long term, but really, if you're buying good businesses that are doing good things at reasonable prices, you should have a multi-decade time frame, time horizon. Fund managers just don't work on that scale. You know, they report their monthly earnings, they have to do quarterly reports, they're out there in front of the media every 6 months. They're bonused maybe on 6 month performance. They're going to do things that respond. Like Munger's exactly right about this stuff and the power of incentives. Their incentives are trying to maximize returns over a short period of time. If you're operating on a longer period of time, that gives you a big advantage over them. It's about the only advantage you've probably got.
Yeah.
But it's a really powerful one.
If I was to say to you that you could only pick one of these two things, so false choice.
Yeah.
Here we go. If I was to say you could only pick one of these two things, a business with a talented leader meets the characteristics that you're looking for. Alternatively, the business operates in an industry that is structurally significant and growing. And the reason I say this is you brought in multi-decade, and you have to choose.
Okay. I would go with the business rather than the leader.
Why? Other than key person risk.
Well, okay.
They could get hit by a bus, but yeah.
Yeah. Well, normally when you put a talented leader up against a bad business, the bad business wins out. Well, we've seen this so many times. But you can have a good business with a mediocre manager and it'll do really well. So I would go for the business over the leader. If you get both, like a talented leader in a good industry where the business has got some tailwinds, great. You know, that's the dream scenario. But if you have to choose one or the other, I would go for the business with tailwinds rather than with the leader with energy and intelligence. What would you do?
Yeah, I'd probably say the same thing. I would because especially on an ultra long time horizon, or like a long term time horizon, I would say the same.
Yeah.
The reason I thought about this is I thought about ARB, right?
Yeah.
And when you would have bought that, would you have known? So you would have known that it's named after the founder and that the kids are involved.
Yeah.
But would you have known that every person in the country just about is going to drive an SUV with a bull bar on it?
Right.
Maybe not.
No, probably not. Probably not.
But it was the right combination because you had the people element and the industry element.
Yeah, and the tailwind.
Yeah. I don't know. Anyway, interesting to say the least. So maybe we can end.
I was just thinking about Tim Cook and Steve Jobs.
Yeah, sure.
Now, I think that they're both talented leaders, but they've got different talents. So Steve Jobs was brilliant on product, absolutely obsessive about it. And Tim Cook is kind of brilliant at supply chains and obsessive about it. If you reverse their positions, so you had Tim Cook doing it, Apple would never have got to where it was with Tim Cook starting at the beginning. Conversely, if he had, and Apple had got to where it got at the end of Steve Jobs' reign, but Steve Jobs was there taking over supply chains and filling this thing out and growing it from a $1 to a $3 trillion company, I don't think that would have happened either. So there were right leaders for the right time. With ARB, whether they're all in the same family or not, I doubt. But, you know, the tailwinds bail people out.
They do bail people out.
They do.
And it can be hard to know for sure, at least in the couple of year horizon.
That's right.
That most people adopt what is being said and what was being done. I heard a really interesting story, speaking of stories this morning. Something that I knew but I forgot was how Microsoft effectively helped bail out Apple back in the day.
Yeah. And it was a crown prince in Saudi Arabia as well. He bought 5% of Apple stock at around the same time that Microsoft did. Microsoft did that for competitive reasons because they wanted a weak competitor rather than no competitors at all. So by keeping Apple alive, they could go around and say, well, look, there is a competitor. You know, we're fine.
It was all the antitrust stuff, wasn't it?
Yeah, it was all antitrust based, yeah. Yeah, that's why they did it. I mean, supposedly they were friends, but I don't think that was it. Bloody good investment.
Too bad they sold it.
That's right.
Would have been the best investment Microsoft ever made.
It's good to know that Microsoft made the same mistake I did.
Well, you know what they say about misery. Okay, so maybe just one or two more questions from me. This is more of a loaded question, but how do you just weigh up active versus passive? I've got to ask, this is like the most stereotypical question. You get someone in, they talk about value investing, intelligent investor. How do you think about it?
Well, go back to what we originally started talking about. I think for most people, passive investing is the right thing to do. But if you're a hobbyist and you want to treat stocks as your hobby, go for your life. Become an active investor. But don't kid yourself that it's easy. It's going to be really bloody hard and trying. And if you're going to do that, go in with your eyes open. So for most people, go passive. But if you're kind of obsessive about stocks and are really interested in business, and when I say that, people say, are you really interested in investing? I think you've got to be interested in businesses. You know, that's what's kept me going. I just love learning and reading about businesses. That's what it boils down to. That's kind of a more important skill than analysis itself. I think understanding the business model, understanding how Amazon didn't make money for 20 years, but was going to start making a ton of money once the flywheel started really spinning and they started spinning off these other flywheels. Like understanding the business first and then getting to the analytical point. But that takes a lot of effort. And if you're not interested in it, don't do it. Stay with passive.
Okay, this other question, I just was thinking about it as you said it, is you've done a lot in your time. What you've built has touched so many investors and educated investors.
Not enough, but
not enough. More people join Intelligent Investor now. That's the message we want you to take home from this episode. But yeah, you've done that. So I'm curious if you've ever given this thought of like, what do you want your professional, we'll just say professional legacy to be? If people say, John taught me, John did this, like how do you think about that? Just generally, big picture, I know, and I've caught you off guard.
I don't see it that way. You know, like it's not for me to determine what my legacy is. I think people who think about their legacies are probably pissing in their own pocket. I don't feel as though it's a thing that a human being should really be doing. Like we're living here, we're living now. Do what you feel is right. Do what you feel is good for the people around you. And then when you die, they can all work out what your legacy is. That's the way I put it. You know, I don't want to put my name on a public library somewhere. Put it like that.
No, but it's I think it's like the people that take the risk and do commit themselves to something. Like, and in this case, it's investing. Who would have thought, right?
Yeah, who would have thought?
Yeah. They can then pass on something to other people and help them make their lives better.
No, you're making a good case. And I don't want to undermine what the work that we've all done, you know, in this business over the years. Like, and it's certainly not me. Like, this has been a massive team effort.
So many great people.
Yeah. And, you know, I don't want to undermine that and don't want to disparage it. But we all do this in our own jobs and our own lives in one way or another, I think. So to kind of evaluate myself, it doesn't feel right. Doesn't feel right to me. We just do what we do, and if people like it and they get something from it, that's great. But you know, there's other people doing way more amazing stuff than what we're doing.
Well, I've got to admit that I hope that at least one of the many thousands of people who will listen to this is positively impacted, and I think they would be, by many of the things that you have learned through maybe trials and tribulations, that they can take something away and it leaves an impact on them. And I know so many people who have watched the track record of the Intelligent Investor subscriptions and now the funds can attest. It's definitely had a positive impact on so many Aussies in particular, but anyone that cares to read or listen in to podcasts and these types of things. So I do really appreciate you taking the time to get on your bike, ride down here.
Thank you.
Hopefully it's not stolen when you get out.
I don't know. It's a very cheap bike. If it's stolen, that'll be good. We can buy another one then.
And I do owe you a book. I'm going to send you in the mail Hans Rosling's Factfulness.
That'll be great, Owen. I've really enjoyed it. Thanks for your kind words. It's been a lot of fun.
Cheers.
Thank you.